So today I'd like to talk about 3 year-end moves that matter most if you're 45 to 60 with money spread across Roth, pre-tax, brokerage, and RSUs. Do these and you'll skip 90% of the noise that's out there. Map your top tax bracket. Consider partial Roth conversions inside of that bracket. Harvest gains and losses deliberately. And pair giving with your tax situation. We do the quick math and we'll have one mini case study and a quick checklist here at the end of this video. So why marginal tax brackets beat average tax brackets? Most folks quote their average tax rate, but planning runs on your marginal tax rate, the tax on the next dollar. Year end is about how many dollars you can add before you spill into the next bracket. Here's how to find your bracket top. Grab your last year's return and your year-to-date pay. Estimate this year's taxable income, and now look up the top of your current tax bracket. Your lane is the bracket top, the estimation, and your taxable income is the room that you have left. That room is where conversions or realized gains can live. Say your estimated taxable income is $195,000 and your bracket tops at $201,000. You've got $6,000 of room. That might be a $6,000 Roth conversion or realizing up to $6,000 in additional gains. Not both, or you could do $3,000 of each. You got to make sure they still fit. Roth conversions, partial and inside the bracket. Principles, not dogma. Roth isn't a religion, it's a timeline. Converting inside your bracket turns future taxable withdrawals into tax-free future withdrawals if you give the money enough time to grow. My rule of thumb is if you can convert without jumping brackets and you have a 7 to 10 year horizon before you'll touch it, it usually deserves a hard look. Conversions are most attractive before required minimum distributions during lower income years or after a year you front-loaded deductions. Don't try to win Roth in just 1 year. Use partials. Fill the bracket lane each December. This shapes future RMDs downward and gives you more tax-free flexibility later. Here's a mini anonymous case study. We have clients 52 and 54 years old. Their lane was roughly $12,000 they had left. We converted $10,000 this year and set calendar reminders for the next 3 years. It lowered their projected RMDs and kept them inside the same bracket each time. This was very slow, quiet progress and no drama. The third part I'd like to cover is harvest your gains and losses deliberately. The point of harvesting isn't about winning or beating the market. It's about matching. Use harvested losses to offset your gains. You can't have 100% winners. You already have or plan to realize. Keep it intentional. We need to watch out for wash sales. If you sell at a loss, do not buy the same or substantially identical stock or security within 30 days before or after. Use a close substitute, Pepsi and Coke, but not a clone. Here are some smart pairings for you to take with you. Realize your gains on a concentrated holding that you'd like to trim. Offset those with harvested losses from another slice of the portfolio. The last thing I would like to cover is if you're charitably inclined. A donor-advised fund lets you bunch 2 years of gifting into 1 year, potentially allowing you to itemize on your tax return now and taking the standard deduction the next year. Funding a DAF or donor advised fund with appreciated shares sidesteps capital gains and secures the deduction, and it makes it clean and trackable for your accountant. So to put this together in 60 seconds, if we have an estimated taxable income of $195,000 and the bracket top next year is $201,000, you've got a $6,000 lane. You've got a legacy position with $5,000 in unrealized gains that you want to trim. You also want Roth exposure. One way to do this is to realize $5,000 in gains now and do a $1,000 conversion, staying in your lane. If you plan to give, you could instead donate to those appreciated shares worth of what you normally give in cash. That may avoid capital gains and preserve room for a slightly larger conversion. The last thing I'd like to cover here is just a quick speed round, a couple of questions that we typically get. The first one is, what if I accidentally cross into the next bracket? Now, that's not a fatal mistake, right? And just know that you're paying the higher rate only on those excess dollars. We avoid it and usually undercut unless there's a clear reason why we might try to push it a little further. The next piece is, do we convert early in December or do we wait? And what we like to do is we prefer earlier. If we can, we'll start conversions in January. If we have a good estimate and we have a good track record of what our client's tax burden is going to be. And we leave a little headroom rather than cutting it to zero. Lastly, can I harvest losses and convert to Roth in the same year? Of course, they're separate levers. Just remember, both consume part of your lane. If they change taxable income or realized gains, two separate levers. Next, we've got a donor-advised fund versus cash giving. If you itemize this year and hold appreciated shares, a donor-advised fund often wins. Avoid those capital gains and potentially increase the deduction. Another question is, what about restricted stock units at year end? RSUs vest as income. Make sure your withholding covers your bracket. If you're concentrated in employer stock, consider a plan to sell on vest and then redeploy those funds. Your year end isn't about heroics. Organize first. List your accounts and find your bracket top. Operate second. Partial conversions inside the lane, harvest deliberately, and pair giving with taxes. Remember, simple beats complex, especially if you're trying to cram this into December. I look forward to seeing you on the next video, and if you appreciated the information in this video, please click a like and subscribe below.